Have you seen that the banks started to trade credit default swaps because of private credit funds? Yes, and that is a very important signal. It tells us that Wall Street wants new ways to protect itself or make a bet as worries grow around the stress in the private credit industry. Reuters reported on April 17 that major banks had started trading CDS linked to flagship private credit funds, and earlier in April, the same Reuters also reported the launch of a new CDS index tied in part to private credit-related firms. So let's make this simple. A CDS, the credit default swap, it's basically a contract, an insurance that works on debt. One side pays a regular fee. In return, the other side agrees to pay if there is a default or another serious credit problem. In plain English, it's a way to transfer the risk of someone not paying something back, as the case the loans. It has been described, that new activity, as a way for investors to hedge against the stress that we are seeing in the private credit. Now, here is where this thing comes in. The private credit funds make loans outside the public bond market, which means those loans are often harder to price, harder to trade quickly, and harder to hedge. That is why the CDS matters here. If a bank or an investor has exposure connected to a private credit, a CDS can help them reduce that risk. Or if they believe pressure is building, they can use it to express that negative view. In other words, instead of waiting for losses to show up, they can buy protection earlier. Well, it sounds like a good thing. And this is why this story matters beyond just one product. When banks start using CDS around that industry, it usually means the market is trying to price the risk more actively. That does not automatically mean that a crisis is here, that it's true, but it does mean investors are paying closer attention to defaults, liquidity pressure, redemptions, and valuation risk in a market that has grown very, very fast. The press also reported this week that the European Central Bank sees private credit as a potential financial stability risk. I've seen that before, even while money is still flowing into the sector. So the short answer is yes, banks are starting to trade the CDS in this area because that private credit fund is becoming big enough, important enough, and risky enough. And the market wants tools to hedge it, price it, and trade it around it. Of course, make money. And when new hedging tools show up, that usually tells you the market is taking the risk more seriously. So if you want more simple breakdowns like this on the markets, on credit and hidden financial risk, subscribe, let me know if you have any questions, and follow me for more. Take care, see you next time, bye bye.